Understanding real estate investment fundamentals. Real estate investment involves purchasing, owning, managing, and selling properties for profit. It is a popular wealth-building strategy due to its potential for appreciation, rental income, and tax advantages. Understanding the basics is crucial before diving into specific strategies. Investors can choose from various property types, including residential, commercial, industrial, and raw land. Each type presents unique opportunities and challenges, requiring different levels of capital and management expertise. A clear investment goal helps in selecting the most suitable property type. Analyzing investment benefits and risks. Real estate offers several compelling benefits, such as potential for capital appreciation, steady rental income, and portfolio diversification. It can also provide significant tax advantages, including deductions for mortgage interest and property taxes. These benefits contribute to long-term wealth creation. However, real estate investment also carries inherent risks that must be carefully considered. These include market fluctuations, property damage, tenant vacancies, and illiquidity. Thorough due diligence and a clear understanding of these risks are essential for mitigating potential losses. Exploring diverse real estate asset classes. Residential properties, including single-family homes, multi-family units, and condominiums, are often the entry point for many investors. They typically offer stable rental income and are generally easier to understand and manage compared to other asset classes. Demand for housing remains relatively constant. Commercial properties encompass retail spaces, office buildings, and industrial warehouses. These investments often involve larger capital outlays and more complex leases, but can yield higher returns and longer lease terms. Industrial properties, like distribution centers, have seen significant growth due to e-commerce. Investing in raw land involves purchasing undeveloped plots with the expectation of future appreciation or development. This strategy requires significant patience and a deep understanding of zoning laws and infrastructure development plans. It typically offers no immediate income, but high potential for long-term gains. Long-term buy and hold strategy. The buy and hold strategy involves purchasing a property and retaining it for an extended period, typically several years or decades. Investors aim to benefit from long-term capital appreciation, rental income, and mortgage paydown over time. This approach emphasizes patience and market resilience. This strategy is often favored by investors seeking passive income and wealth accumulation without frequent transactions. It can be particularly effective in growing markets where property values are expected to increase steadily. Successful execution requires careful tenant selection and property maintenance. Short-term fix and flip strategy. The fix and flip strategy involves purchasing distressed properties, renovating them, and then selling them quickly for a profit. This approach typically requires a keen eye for undervalued properties and efficient project management skills. The goal is to maximize value through strategic improvements. Success in fix and flip depends heavily on accurate cost estimation, timely execution of renovations, and a strong understanding of local market demand. While potentially lucrative, it also carries higher risks, including unexpected repair costs and market downturns. Speed and efficiency are paramount. Generating income with rental properties. Investing in rental properties is a classic strategy focused on generating consistent cash flow through tenant rent payments. This approach provides a steady stream of income, which can cover mortgage payments, property expenses, and contribute to the investor's overall profit. It's a popular choice for those seeking recurring revenue. Successful rental property investment requires effective property management, including tenant screening, lease agreements, and maintenance. Understanding landlord-tenant laws and maintaining good relationships with tenants are crucial for minimizing vacancies and maximizing profitability. Professional management can also be hired. Investing in real estate investment trusts, REITs, Real estate investment trusts, REITs, are companies that own, operate, or finance income-producing real estate. They allow individuals to invest in large-scale portfolios of properties without actually buying or managing them. REITs are traded on major stock exchanges, offering liquidity not typically found in direct real estate investments. Investing in REITs provides several advantages, including diversification, professional management, and often high dividend yields. They offer a way to gain exposure to the real estate market with smaller capital and greater ease of entry and exit. However, like stocks, their value can fluctuate with market conditions. Securing real estate investment financing is a critical component of most real estate investments, as few investors pay cash for properties. Common financing options include conventional mortgages, FHA loans, VA loans, and private money lenders. Understanding the terms and conditions of each option is essential for making informed decisions. Beyond traditional loans, investors can also explore creative financing strategies, such as seller financing, lease options, or partnerships. Leveraging equity from existing properties or utilizing hard money loans for short-term projects are also viable options. Each method has its own risk and reward profile. Conducting thorough market analysis and due diligence. Market analysis involves researching economic trends, population growth, employment rates, and local property values to identify promising investment areas. Understanding supply and demand dynamics helps investors make data-driven decisions. This research informs whether a market is poised for growth or decline. Due diligence is the process of thoroughly investigating a property before purchase to identify any potential risks or liabilities. This includes property inspections, title searches, environmental assessments, and reviewing financial records. Comprehensive due diligence minimizes surprises and protects the investment. Effective property management practices. Effective property management is crucial for maximizing returns and ensuring the longevity of a real estate investment. Key responsibilities include marketing vacant units, screening potential tenants, and drafting robust lease agreements. Proactive management minimizes vacancies and tenant issues. Ongoing property maintenance, timely rent collection, and managing tenant relations are also vital aspects of property management. Maintaining the property's condition and addressing tenant concerns promptly contribute to tenant satisfaction and retention. Efficient financial tracking and budgeting are also essential. Planning your real estate exit strategy. An exit strategy is a predetermined plan for how an investor will liquidate or dispose of an investment property. Common exit strategies include selling the property outright, refinancing to pull out equity, or holding the property long-term for continued rental income. Planning this in advance helps maximize returns. The chosen exit strategy depends on market conditions, the investor's financial goals, and the property's performance. For example, a strong seller's market might favor an outright sale, while a need for cash flow might lead to refinancing. Flexibility and foresight are key to successful exits. Navigating legal and tax implications. Real estate investment is subject to a complex web of legal and tax regulations that vary by jurisdiction. Understanding property laws, zoning ordinances, landlord-tenant laws, and environmental regulations is crucial for compliance. Seeking professional legal advice can prevent costly mistakes and ensure smooth operations. Tax implications are significant for real estate investors, including property taxes, income taxes on rental revenue, capital gains taxes on sales, and potential deductions. Depreciation, 1031 exchanges, and other tax strategies can significantly impact profitability. Consulting with a qualified tax advisor is highly recommended to optimize tax efficiency.